Welcome to the Options Hour. This is TFNN, and my name is Victor Jones. And over the next hour, we're going to be talking everything options. Obviously, we just got off a triple witching expiration week. A little bit, kind of an interesting way to end expiration. We're going to talk about, last week's action, but more importantly, we're going to be talking about the action coming up into January expiration. Again, this is, as always, a call-in show. We welcome everyone to go ahead and give us a call. Throughout the hour, let's talk about, existing positions. Let's talk about, positions you're looking to put on, positions you may have rolled, and obviously in a market like what we have today, to just give a summary to everyone out there listening, S&P 500 trading 1228.5. That's up 29 3/4 on the day, about 29.5 points. And, interestingly enough, if you were watching the market earlier this morning, we were up about $18 and shot up 25. Basically added a quick 7 points on the market in less than 60 seconds. So interestingly enough, for all the guys here on the desk, that happens, and we all look at each other and we think kind of short squeeze, an interesting short squeeze, a $7 movement up to 25, and over that next hour or so, we've rallied up 30 to right around the 1229 handle. We've been sitting here for a few hours now. But again, it was an interesting expiration cycle. Again, a triple witching, and then to see that market action, on Friday, where we were basically positive for most of the morning, reversed into the end of the day, was interesting. You typically have an upward bias into, especially a December expiration. Seasonally, it tends to be, an upward biased expiration. So it's kind of interesting market action we had. Nonetheless, we traded down to that 1200 level yesterday. And true to the range we've been trading over the last, I can't even call it now. We'll call it, basically, maybe the 3 expiration cycles. But essentially, we've made this nice little range at 1200 to 1265. And, we overextended that 1200 level a little bit into the beginning part of the December expiration cycle down to 1150. But again, quickly rallied up to the 1265 level, ran out of steam, and now, where did we hit? Almost exactly 1200 before rallying here. So, we've got a very, very interesting kind of setup here for January. But, before we get into that, before we get into how we're looking for January, obviously we always want to take calls. Our first call is from Barbara in Lakewood. Barbara, how are you?
Hi there.
Thanks for the call, Barbara.
Thanks. So I'm calling about this. I bought 3 leaps in EWJ.
Sure.
Right after the earthquake in Japan, thinking that I got the bottom. They expire in January. They're January 10th calls, and they're pretty much worthless, it seems. So I'm just wondering if there's any saving of them, or should I just let them expire?
So when you say they're leaps, we're looking at January of 2013, or are they actually January of this upcoming expiration?
Right.
Or are you looking at 14?
Yeah. Right. No, 12.
Okay. So they're the January 12 10 strike calls, right?
Right.
Okay, perfect. So, essentially right now, Barbara, you're exactly right. We're trading at, a penny by 2 cents. So in terms of, any repairing, obviously that's a very difficult scenario. Now, can I ask, EWJ today is trading right at $9. And and could I ask, where did you, in EWJ, do you remember exactly where the underlying was traded when you went long those calls?
I think it was 9.
It was right around $9.
Right.
Yeah. What's interesting is it did retreat a bit, right? It made a low this year of $8.83.
Right.
So the question I would have for you, it's based around 9. It broke 9 to 8.83, but you can see it recovered and ran to $9.50. How comfortable are you with $9 being a level support in EWJ?
No, I think it is. In fact, I'm bullish into 2012 on EWJ.
Okay. So then what's interesting here is not necessarily the purchasing of the calls, to potentially roll that. And obviously it's not even worth selling them because you won't even get the cost of the transaction and what those calls are worth. So clearly you just want to hang on to those. If you get a little bit of an uptick, take the profits to cover transaction costs. But, the interesting part about EWJ, and this is for everyone, for all the listeners out there, EWJ is an iShares fund that it's basically an index made up of Japanese firms, Japanese holdings. $9 is an interesting support level, and it's holding that level here today. So what could be potentially interesting is looking at, instead of going long premium, and picking an upside target, saying, I'm going to be bullish, but I think 9 is a good base. So how can I take advantage of this without and put probabilities on my side, which we so often talk about, Barbara?
Mm-hmm.
So, selling something like selling the 9-strike puts today brings in about 23 cents in premium to do that. So I would ask you, I know that obviously you're familiar with going long calls. Have you in the past looked at potentially selling puts as a way to take advantage of a bullish outlook?
Yes, I have. I do that.
Yep. And so what's interesting here, again, because we're basing here at $9 to take a conservative approach to sell those 9-strike puts, you essentially put yourself, well, where does that put your break even? Well, it puts you right at $8.88. And then we made a low of $8.83. So essentially you're putting yourself at your break even. You would have to essentially make a new 12, obviously a 52-week low, to actually, break your break-even point. So I think it's an interesting from a probability standpoint. For every one time you sell that, that's about $880 worth of capital that you'd actually put up to do that, assuming you're on a straight cash basis. What would be interesting as well, but a little bit more difficult, is if you look at those 7-strike puts, and those are essentially worthless, right? They're all basically zero bid at 5 cents. So if you wanted to save a little bit of money, Barbara, what you could also do is sell the 9-strike puts and buy the 7 puts, which are essentially worthless. Maybe you pay a penny or two, potentially a nickel, to do that. And you won't take in, let's say, 23 cents. Maybe you take in 20 cents or 19 for every one time you do that. But it'll actually only cost you $180 in terms of capital to put on that particular trade. So there's ways that you can utilize what's called obviously a vertical spread to limit how much capital you actually have to put up without taking away from your potential return to the same effect. So, instead of putting this on and potentially having to use $900, you're putting this on and using, no more than $200 and not taking on more than $200 of risk. Does that make sense, Barbara?
It does, and I remember you talked about that a couple of weeks ago, and I've really been looking at that instead of just selling the puts, buying them much. But really what you're doing, if I do that, then I'm just letting go of this January 10th call, right?
I mean, we really have to look at them, right? So what could we do with a long call? Well, it's 1 penny at 2 cents, and let's say, it costs you $1.50 a contract to execute a trade. You can sell this right now basically $1, so you wouldn't even scratch in terms of transaction cost to sell it. Right. And then you couldn't sell anything behind it, like you couldn't sell the 11 calls or the 12 calls. You couldn't do anything like that because all of those things are worthless. So in terms of repair for something that's trading at 1 penny by 2 pennies, you're very limited in what you have available. Now, so that's why I recommend, not a recommendation, I would just say, hey, if you're going to try and sell something and it costs you more to sell it than you get for actually selling it, if the transaction costs don't outweigh the benefit of selling it, you would never do that, right? You would just keep on to it in terms of, saying, hey, we might have a nice uptick into expiration, and if I'm assuming you might have paid somewhere around, 50, 75 cents, maybe an upwards of $1, depending on how long ago.
Yeah, 95.
Yeah. Yep. So, you would have to make a significant move in the next 31 days, and the probability that it actually goes and touches $10 is like 10%. The probability it actually expires above that is half of that, so 5%. So you're looking at very low probabilities, but still probabilities nonetheless. So holding on to those, you have more opportunity costs in holding on to those than you do actually selling it because it'll actually cost you money to do that.
Right. Well, this
Yep.
has been very helpful.
Well,
And
Barbara, I
really
appreciate
like
the
your
call. It's a
show.
great, it's a very interesting point in terms of calling right around the timing that you are. Again, there was some basing there at 925, and unfortunately, it ran past that and found a new level of support kind of around the 9 and 880 level. But if you still do have that bullish outlook, I think rather than buying calls, because the timing of that upward move is a little bit tough to anticipate.
Right.
And from a probabilistic standpoint, buying calls again might put you on the lower side of a lower than 50% in terms of probability. This puts you right around 50%. But if you are pretty adamant that 9 is a nice support level, it could be an interesting play. And there's ways to shore up the amount of capital you'd use by buying something that's really, really cheap and out of the money.
Sounds good. Great.
All right.
Well, thanks so much, and I love your show.
Oh, thank you, Barbara. Thank you for the call. It's a great question.
Great. Thanks a lot. Okay.
Take care. And we appreciate that. I mean, those are very kind words from Barbara and kind words from everyone out there in the chat. These are great, great calls, and we'll go ahead, if we could, Al and all the kind folks here in the TFNN network, we'll go ahead and post that number here in the Tiger Den for all of those listening on the chat as well. We appreciate that. So, Barbara brings up a great point, and she mentions that we've talked about it here on the show before. And I think when it comes to options, there's a lot of things that we probably get used to or get exposed to first. And those first kind of strategies, I'll call them, are the covered call. So if I'm a long stock trader, how do I give up some of the upside, even though it's a low probability we get to that potential strike price? How do I give up some of that upside, increase the income that I'm bringing into my portfolio, essentially utilizing probabilities in my favor to either decrease cost basis or create some sort of monthly income? And the same thing on the put side. So essentially, from a synthetic standpoint, a covered call is the exact same strategy from a synthetic standpoint as selling puts. So, and a lot of people, that's an interesting kind of question. That's an interesting concept. So I want to show this visually for everyone out there, the term of synthetic, because I think we always tend to start with, what is, why would I do covered call, or I'm using covered calls, I'm using, I'm selling puts, but, we don't understand all the time that maybe that's actually the exact same. So I'll show those here in just a few moments. I'm going to bring it up visually. First, we want to take a call from Mike in Lakeland. Mike has a question on ISRG, Intuitive Surgical. Mike, thanks for the call.
Yeah, hi, Victor. Didn't expect you that fast. Thanks. Thanks for everything you guys do. Yeah, I got a quick question for you. I haven't done this trade yet, and I usually use options pretty simply, so I'm not that sophisticated, but I wanted to get your thoughts.
Okay.
What I usually do is if I'm long, I'll buy a put underneath, or if I'm short, I'll buy a protective call up above.
Sure.
So I am Intuitive Surgical is trading at 442. I think I have major resistance at 450. She's also forming this huge triangular pattern, stretched over weeks. Earnings are on January 19th.
Okay.
Options expire January 21. So ordinarily what I'd do is on a day like today, if I think, I would come up and I'd try to short a small, and it's very thinly traded, short a small position up here. If I get a pullback and then try to buy, a 450, call maybe, and spend the money to protect myself. As opposed to doing it that way, I know that's probably not the most sophisticated way in the world, but if I had a bearish slant going into earnings, I just wanted to pick your brains on how you might play that. Or suggest.
So it's a bearish play going into earnings, and you're looking to short the underlying stock. So you actually go, you commit, quite a bit of capital to do that in Intuitive Surgical, and then you buy a call in order to basically protect yourself. So it's a married, just like covered call, married puts, those types of things. So you're protecting yourself, or you're giving yourself the right to always buy it at 450, so that if there is a run up in terms of earnings, you've protected yourself a little bit.
Right.
So,
right. That's what
the
I've
question
done.
is, what are the alternatives, or potentially what are the risks in doing that, right?
Yeah, I think I know the risk. I can define my risk. But I wanted to know maybe a better alternative going in, that said, I guess, if you...
Okay, so I'll just say a couple of things, and I think it's kind of interesting, and it'll take a moment to maybe think through the strategy here, but what's interesting here is you're going long the stock and you're buying protection, right? So what's automatically going to happen is
I would have been short.
Going short the stock and you're buying protection. Excuse me. Yeah. And what's automatically going to happen come earnings is you're going to get that volatility crush, right? So you're going to lose, even if, let's say, the stock sits still or moves in your direction a little bit. The protection that you've actually you've bought is going to suffer because you're going to get that volatility crush come earnings, right?
Right.
So you've got the good thing, though, is that earnings happen so late into the expiration cycle. They're going to be trading, they're definitely not going to be trading at intrinsic value as a lot of other securities would as we approach expiration. There's definitely going to be some extrinsic value, but maybe not to the extent that you're seeing built into the options today because of all the time. So I think what's interesting here is if I were to look at the chain, can I ask why you choose, and then let's just look at it from a capital perspective, can I ask why you choose to go short the underlying stock versus buying, let's say, a high delta put?
Yeah, well, it's just because it's always what I've done, I guess, lack of knowledge.
Right. Sure, and so one of the things, and again, you have to kind of weigh the benefits with the risk here. So one of the things that I would probably look at, and going into earnings is a little bit different situation for the same reasons, but what I'm looking at here is I've pulled up delta on the option chain, and I've pulled up extrinsic value, okay? And so I'm just looking at something that's in the money. So if I'm going to go short, let's say an underlying security that's worth $442, let's just pull it up here. And typically, what's the position size here? I'm just curious.
100 shares.
Okay. So let's just look at 100 shares. In terms of capital there, that might cost us, let's just call it $150, right? So let's just call it $150, so $15,000 to put up capital on that, right? Going long and in the money put, to take the same delta position or theoretically very similar or equivalent delta position, you look at this and basically it would, basically takes half of the capital to put something like that up, maybe $7,600 or so, and you get a delta of 92, which essentially means for every $1 you move down, you would get, 92 cents on the dollar. So stock, you're going to get dollar for dollar, and in the money, put with this high of a delta, and you could even go a little bit deeper in the money, spend a little bit more money, and get something a delta of 1 to 1. So the same relationship you'd get on a down move with stock, you'd actually get with Intuitive Surgical as well. And then, what's the benefit of doing something like that? Well, there's limited risk versus actually going short, but the risk that you put in here is you always have to measure that extrinsic value. So what I would look at, and what I'm looking at on this option chain, and I'm measuring between the 520 and the 530 put, is the extrinsic value here. So I'm looking at the extrinsic value, and I'm saying that, that 530 put has only 4 cents of extrinsic value. And what does that mean? Well, when earnings come out, there's this, and as volatility, the vol crush comes out of these options, well, there's only 4 to, let's call it 10 cents of extrinsic value built into this in the money put anyway. So what am I doing? I'm essentially limiting my capital. I'm accepting that, yes, on a vol crush, I'll maybe lose 4 to 10 cents on one of these options.
What strike price are you talking about? Because
I'm looking at both the 520 and the 530 puts in January. So these are deep in the money puts that have a high delta. So in a sense, they'll act very similar, or theoretically similar to the underlying stock in terms of a short position.
Okay, I see.
Yep. And so what I'm just looking at is, it has a delta of close to 93 or 1. Yeah, go ahead.
I was a bit lost on that. I'm sorry. So I'll listen again.
And I'll go over, and I apologize about that, Mike, but what I'm looking at is the 520 and the 530 strike here in Intuitive Surgical in January. And the only reason, again, I'm just doing that because when you're shorting stock one, obviously that's why you're buying the call. You have unlimited risk in the first place, right?
Yeah.
And it's also very capital intensive. So what I'm looking at here is there's the potential here to use half of the capital for theoretically on a down move the same gain or very similar gain on the downside, and also limit your total risk because you're going long potentially a put that has a limited investment up front. So what I'm always weighing though is that extrinsic value and how much you would potentially get taken away from those options on that vol crush of earnings. And I think so what I'm always looking at is how to measure that against it, and does it make sense to possibly limit or go half of the capital in the upfront investment for a very similar return if I can get that with very low extrinsic value. And I think there's the opportunity to do that there in the 520 and 530s at low extrinsic value, even the 540s, save capital.
Okay. I'll have to think that through. Well, I appreciate it. It's a different way of looking at it, for sure. I'm just figuring that, come earnings on the 19th, my trade will be over one way or the other.
Sure, absolutely.
On this.
And that's part of the reason why we're considering extrinsic value on that put, because we know right after earnings come out, right, now, there's no longer any uncertainty, and you've essentially got 1 day to expiration, so everything's going to be trading at pretty close to either a delta of 1 or 0. And so these things, all the extrinsic value basically comes out of these things. So looking for a way to save capital and not expose yourself to a ton of extrinsic value would be important.
Well, when I do the risk, when I think about it, if I buy the 520 put, and the trade it goes against me, I mean I'm going to take. I could take a 15. I see a 15. Yeah. Okay, I'll have to think that through and run the numbers. I appreciate it.
No, it's no problem. And again, Mike, it's not a change in strategy at all, right? It's not a change in strategy. It's just a way to potentially take advantage of the same strategy and use half the capital. That's essentially what this is. But the risk that you run is the execution. And in something like Intuitive Surgical, which you mentioned right off the bat in this call, that it has a lower level of liquidity just because it's a little bit more expensive. You look at those options and you see maybe something that's $3 wide. To execute on this strategy, you might give up something in edge to get into the position. So you give up a little bit of edge to save half of the capital. So just depending on your position size, it may make sense. Save the upfront capital, utilize options to take advantage of again, it's just the same strategy, just looking at ways to potentially save the capital or utilize a little bit less upfront capital.
Very good. Okay.
Very good. Thanks for the call, Mike.
Yep. Bye.
And it's interesting, and I think we'll think through the strategy here. And actually, I think when we go through the covered call and the put scenario, we'll look at kind of how all these synthetics kind of work together. So we've had some great calls today, and if you guys have some more questions, feel free to give us a call. Again, we're going to be taking calls for the entire hour here, so we're looking forward to basically anything you guys have out there. Again, so we were looking, let's just look at synthetics, and I'll use an underlying. I'll ask the fine people in the Tiger Den here to give us some underlying securities to look at. So, if you have a particular underlying you want to take a look at in today's session, go ahead and type it in for me in the Tiger Den, and we'll use that. Perfect. We've got a couple of things coming in here. We've got JBL, so we'll go ahead and use JBL. We'll go ahead and type this in here. And so we're trading $20.02. Decently liquid options market here. We're about 5 cents wide between the bid and offer, so nickel wide in these markets. So we'll go ahead and use this, and we've got a couple of nice people in the Tiger Den posting some securities that we'll look at in just a moment here. So let's just look at it this way, right? So we've got JBL, which is trading $20, let's just call it, on the day. So what if I don't have a position in JBL? I know I want to go long, and then I'm looking or I'm monitoring the opportunity to sell a covered call against it, a high opportunity to bring in some premium that I know I won't get called away on the stock, or there's a high probability that I don't get called away, obviously we have to say. So if we just look at probabilities, with volatility of 56% in the underlying security trading at $20, the probability that we trade above $21 in JBL is 34%, which essentially means, let's just call it 35. That means if we take the inverse of that, 65% of the time, given the current pricing inputs and the current market conditions, we would expect to expire below $21 between now and expiration. Well, if it's, a covered call is kind of a schizophrenic trade because you're saying, I want to go long the stock. I think it has tremendous upside potential or small upside potential. And, that's essentially what you're taking the position on. But when you're selling the call against it, you're saying, okay, yeah, I think it has upside potential, but actually, I don't think it's very probable it gets above this certain strike. So it's almost kind of this this schizophrenic position, if you will. And so let's just look at it again. So the underlying stock is trading at $20, and the 21 strike call in January, let's just call it, is 75 cents. So what does that mean? I effectively, if I buy the stock and I sell the call simultaneously, I effectively have a cost basis that's $19.25, right? $20, which is the cost of the underlying, minus 75 cents, which is what I get up front for selling the call. I've effectively lowered my cost basis on entry to $19.25 in the stock that's currently trading at $20. That's effectively how you can look at this. So if I visualize this for everyone out there who's actually watching the screencast, I want to show everyone what this actually looks like if we're going to buy covered stock. And we'll just analyze this trade here. You can see what essentially happens is, we have a profit potential up to our short strike price, which is 21. And at 21, we essentially level off. And why is that? Well, we sold a call at the 21 strike, which means we are obligated, if it goes higher, we're obligated to sell the stock there. So we are long stock already, and we're obligated to sell that away to the holder. So, we can even do some fun things here in terms of probability and see, what's the probability that these things occur between now and January expiration. And basically, there's a 55.6% chance of break even potentially in this underlying trade. So, you can see visually exactly what this graph looks like. Now, what happens if I take you back to the option chain, and if instead of selling the covered call at the 21 strike, we look, let's say, at something very similar. What if I were to just sell the corresponding 21 strike put for $1.70? You'll notice that this risk graph looks exactly the same. Well, why is that? If I sell a put at a strike price, what do I essentially have to do? Right? I'm obligated at that point to buy stock at 21, right? So if I'm buyer of the put, I'm obligated to sell, or I'm not obligated, I have the right to sell at that underlying strike. If I'm selling the put, I'm obligated to buy it. So what happens? Well, I'm obligated, once we go above 21, I'm essentially obligated to buy it at that price. So I'm buying at 21, but, essentially I have a cost basis here, and I'm bringing in $1.70. We'll just call it $1.75, so we'll make the math easy. So $1.75, the underlying is trading right around $20. So I'm bringing in $1.70 to do this from 21. So if I subtract, let's call it $1.75, where does that put me? Well, it puts me right where we were discussing before, which is right at $19.25. So essentially, when we look at this, a $19.25 entry with a 21 exit, that's essentially what we're looking at in terms of this strategy, if you will. So for all of you out there who have looked at this, what is the differences? Well, there's two potential differences here. One in dividends, and if you own the underlying stock, you'll actually receive a dividend. Whereas, and keep in mind, it's always expected. Dividends, for the most part, are always expected, and for the most part, known or announced ahead of time. So those are actually, built into the price of these options. So essentially, a lot of times, if you're selling this put, you're doing that with the understanding that some of that premium will come out because, the stock will decrease by whatever the price of the dividend. So a lot of that is built into the price of the option, but it's not the same as receiving the dividend. And if, you're trading something that does have a dividend, then by all means, that's something to consider. But from a strategy perspective, these are what's called synthetic positions. If I were to do one synthetically, I can create that same position another way or create that exact opposite position another way as well. So I think it's important, it's important that we understand this. And why is that? Well, essentially, what would be the difference if I don't own the stock? If I don't own the stock, what would I want to do? Well, it depends on your firm, right? If you were to submit a buy right order, you charge 1 or 2 commissions. Well, if you charge 2, well, maybe it makes sense to sell the put because you're going to get charged 1 commission. If that's something you do consistently on multiple stocks month over month, we talk about commissions at the end of the year. When we talk about your overall return, that could be a couple of percentage points. Just knowing that there's a synthetic equivalent that could cost you less money in terms of transaction. But also, if you own the stock, if you already own the stock and knowing, hey, I'd like to sell puts on this underlying stock, knowing that same synthetic position is available, just going and selling the covered calls, and you've essentially put on a synthetic short put. From a trading perspective and from an option perspective and just getting familiar with these different strategies, I think it's imperative. And it's something, if you've been trading options for years, maybe you're familiar with selling puts or selling covered calls, but you didn't, the idea that these were synthetic and basically equivalent to each other might be a new concept. So, I want to thank everyone, obviously, for kind of letting us go through that explanation. Hopefully it had a lot of value for a lot of people out there, because I think most people when they start trading options, they start out potentially with selling covered calls or selling calls against stock that they own for income, or selling puts on stock that they don't own for potentially, cheap entry points, or to generate income on securities they think would be interesting buys. So that said, let's do a quick market wrap, and let's go through. And I think before we just talked about the S&P, we always want to give an update on the entirety of the market. So let's go ahead and do that really quickly. The S&P 500, 1229.75, up 30.75 on the day, basically 31 points. We just hit 1230 on the day. So interesting momentum here. Again, on the open of the day, up about $18, and we've quickly moved, I think, in a nice little, and you could call it what you want, but maybe a quick little short squeeze at 25, and we've continued that momentum up to the $31 level. Now, that said, we also have the Dow. Obviously, we want to quickly quote the Dow, 11,978, up $277. Interestingly enough, we are approaching that 12,000 number in the Dow. So, as we approach that number, I think it's an interesting number in the Dow, but clearly the Dow and the S&P 500, the tendency is to move in tandem. So if you think in the S&P 500 the upside resistance is 1265, it's tough to call the Dow then reversing at 12,000. If you think this is a reversal point here in the Dow at 12,000, it's tough to call an upside price target at 1265. So just be aware of those different relationships there. We'll also quote the IWM, that is the Russell 2000, trading $730.70, up 27.20 on the day. A few commodities here for you guys. The gold GC, the forward contract here in gold, 16.50 up 19.80, and crude. And we're definitely going to talk about crude just as we're going to talk about gold, because maybe if you've noticed over these last couple of sessions, when we start approaching an interesting resistance number or an interesting support number, what do? We look at high probability ways to take advantage of potential reversals, either quick or level shifts in that underlying security. Gold is no different when we hit that 1800 level, and crude was the same thing when we were approaching 100. So we want to talk about those really quickly, but interestingly enough, crude is at 97.30, up $3.25. And so let's just jump into those really quickly. If we have any more calls there, guys, we had a couple of great calls earlier here. We are at 877-927-6648. We've only got maybe 20 minutes or so, but we're going to take as many questions as we can. So feel free to give us a call at 877-927-6648. Let's talk about positions you have on, opportunities you're thinking about, alternative to opportunities, or risks in those potential opportunities. Give us a call, guys. We'll talk about it. 877-927-6648. That said, let's jump into to gold first and foremost, because that one, we had talked about it constantly, about kind of the potential risk there of trying to catch that trend a little bit too late. We thought 1800 in GC, and last time we talked about how that corresponded to GLD. If we flip over to GLD, essentially the 1800 level in GC was kind of the 170 level, and GLD was kind of acting as that proxy, so to speak. So you don't have a direct 1-for-10 relationship there. But, so what we did last time was we looked at selling some potential call spreads there at the 170, actually the 175 level, when we were hanging right around 170. And, into December expiration, we had a nice move with GLD off to the 150 level into expiration, and the trade worked out beautifully. And same thing with gold. We'll bring it up really quickly. /CL in the ThinkorSwim platform is the contract, the continuous contract for light sweet crude. January is the current active month in that futures contract. And, again, $100, it doesn't matter when you started looking at gold, whether it was in 2007, whether it was, years before that, but, 2007 when we started to have that commodity bubble and we ran to basically we broke the 100 level and broke to, 154, whatever it was. And then over the last couple of years, obviously, we've tested 100 several times, but the idea that $100 isn't this major psychological level in crude, you have to kind of be respectful of that long-term relationship, if not over the last 3 years, then essentially over the lifetime of the contract. So, at least when we started to level shift into $100 barrel of oil, let me go ahead and make sure we clarify that. So, as we looked into, or we positioned ourselves around December expiration, gold was right around the $100 level. And I think, we took some interesting plays. We showed some interesting kind of call spreads there at that $100 level. And we made a move off to 95 into December expiration that also played very, very well. And I think here's a difficult part. I think, as we approach 100, We'll look for some interesting opportunities into January. I think if you're looking at potentially putting on a bearish position here in crude, not to say don't stop you, but if you have, let's say you've got 10 contracts you want to put on, maybe the idea here is start with 2. As you approach 97.5, maybe you start with just a couple of contracts, and that way when you work into, let's say, 99, 100, potentially even 102, because we've seen a couple of highs here over the last 2 expirations where we've broke basically into the 102 half level. So, there's different ideas around diversification. And, it's diversification of product, but there's also diversification of trade. If I could sell, let's just look at a few here. Let's look at, we'll just look at OIL. There's different opportunities here, and this one may be less liquid than others. I just want to look at it for trading purposes here. If we look at OIL and where we've traded here, the crude oil ETN, I think we looked at kind of the 26 level, and we sold off into the 24 level here. Again, it's just essentially if I could go and sell the 26 calls here, you get about 20 cents. In doing that, you're one wide. You've got an 80% probability of success. Well, maybe you do that today, and as you approach 26, you get better and better prices depending on how comfortable you are with that upside resistance. So essentially, you're taking it potentially a 20-cent 2-contract trade, 25-cent 2-contract trade, 30-cent 2-contract trade, and then maybe you put on the last 10 at 40 cents. You've diversified essentially your break-even and the premium that you've received in doing that. So I would encourage all of you, if you've got 5 contracts to trade, you've got 10 contracts to trade, whether it's a spread or whether it isn't, and you're not 100% confident with the support or resistance levels that you're approaching. And I think it's difficult because when are we 100% confident that we've got a winner in our hands? But I think there's always times where, from a probability standpoint, you're more comfortable with a heavy resistance number or more comfortable with a heavy support number than before. So if you're approaching those numbers, you want to make sure you don't necessarily, quote-unquote, miss that move or miss that reversal. And you've got, you're not putting on a 1 or 2 lot trade, and you think there's the opportunity to diversify in the premium that you would receive. I would encourage you, again, take a look at diversifying those trades across pricings. Because if that trade does immediately work for you, I promise you, you're not going to be angry, right, because you've got a winning trade working in your favor. And as the trade potentially works against you, I'll call it, you have a plan. You have a trading plan. And essentially, you've almost wanted that so you could get a better price as the stock came towards your eventual support or resistance point. So it almost does something to a trader psychology as well. If you don't, let's say, shoot all your bullets at one time, you have a plan in exactly how you're going to execute the execution of those multiple contract trades. So I just say that, in terms of helping people in terms of execution. But, as we wrap up here, we've got about 13 minutes to go. I wanted to pose, one more opportunity here at 877-927-6648. I think, a 30-point move, if you look at essentially what we've seen over the last couple of weeks. I mean, this is, from a volatility standpoint, well, the VIX is down to 23.29, down $1.63. From a volatility standpoint, we're not getting higher volatility from an option standpoint. But if you look at just historical move, right, you just look at historical move over the last couple of months, a $30 move is a pretty substantial upside move. We have a couple $50, and but I think $30, you wonder, hey, do buyers have enough momentum really to pull us a little bit higher than the 1230 level? And I say that for all you intraday traders out there. Just be careful if you're looking to take short-term gains on a move that's already moved $31 to the upside and has sat here, let's call it essentially the last, maybe hour and a half or so, because that's what we've essentially done. So you're seeing buyers and sellers. Maybe you're seeing a little bit lack of liquidity. Maybe you're seeing buyer and seller match. But regardless, you're seeing a little bit less momentum to the upside. So for those of you who are looking to take intraday profits, just take a look if you're trading on that long side of any potential ranges into what potential correction we can have into the close of the day. Now, the last thing, or not the last thing, obviously, but we always want to talk about the VIX, right? We want to talk about the VIX, and we quickly mention that the VIX is currently at $23.29. That's down 6.5% on the day. The reason I bring this up is because so often we talked over the last couple of months about levels. We talked about levels in the VIX. We talked about how essentially over a very, basically most of the beginning part of 2011, I'll call it the first 7 months, we've essentially created this range of $15 to $20 in the VIX. And over, let's call it the previous 4 months, maybe the previous 4 expiration cycles, we basically had a level shift. And I mentioned that a couple of times. This level shift was essentially the range was even larger, 30 to 45 in the VIX. For about 3 months, but then it was more like 30 to 35 once volatility kind of came in a bit. So 30 to 45 and then 30 to 35. And we broke 30. And the first thing that we said was, let's be careful here. Let's be careful, and why should we be careful? Well, we might be playing in a new kind of level shift. So the assumption wasn't, hey, we've got cheap volatility here, let's see what we can do. It's, hey, we might be playing in a new level of volatility, getting a little bit closer to what we saw in the beginning of 2011. And so far, over the last expiration cycle, we've had a clear downtrend from 35 down to the 25 area in volatility. So I think, if you're trading on volatility and you're looking at, hey, what's relatively expensive, what's relatively cheap, I think into the end of the year and definitely in the beginning of 2012, we have to be careful that, look, the kind of the ball game or the parameters, the paradigm for volatility and the range of volatility may have changed a bit. And if I were looking for potential support here in volatility, I think 20 to 30 might be an interesting range. And again, that's volatility is going to tell us what it will. But if I look just at this chart and I say, hey, resistance here was at the 20 level before, support was at the 30 level, I think obviously, all technicians might say, hey, we might play in this range of 20 to 30. So we maybe need to level set now on what our new expectations are in terms of market volatility, and then obviously position volatility. So if let's look at ways that we can potentially take advantage of that. So we know we're trading right in the middle. Let's make that trade assumption and say 20 to 30 is our new expected range. Well, right now we're trading right at 25, and I think that's actually, while it doesn't tell you we're at 30, so maybe I should look at selling more premium. We're at 20. Maybe I switch that and I look at buying a little premium because premium is cheap here. 25 actually is interesting because it actually gives you the ability to choose your strategy based on what you're more comfortable with. At 25, again, we're in a downtrend here, so whether or not we touch 20 into the end of the year, it's definitely a possibility. So if the expectation is for lower volatility here, clearly you'd want to be short Vega. Short Vega meaning basically, short vertical spreads, potentially, or short calls, short puts, those types of things. And as we approach that $20 level, it could be interesting to start looking at, how do we go long Vega a little bit, maybe some calendar spreads, maybe going long options or long spreads, whether they're out of the money or in the money, or I shouldn't say in the money, I should say right at the money, those types of spreads. So we'll look at a few underlying securities. We had a couple people type in some earlier. So at a 25 VIX, how would we be looking to play these underlying markets? So BHP was something that was typed in earlier at $70.21, up $2.82 on the day. And we look here. Obviously, we'll bring up the chart for everyone that's watching that screencast. We look here and again, very familiar pattern. As the market reaches some basing level, it's very, very apparent or very probabilistic that you're going to have a lot of underlying securities showing certain basing patterns. And BHP, if we look at where we are, 70 has been a support level over the last 3 expiration cycles. Clearly, we broke down to 62.5, but 70 has remained, let's call it, somewhat of a relative number here in BHP over the last, even if we go back to basically the July expiration cycle in addition to that. So, at the 70 level, what's interesting here? So we'll go to BHP. We'll look at what's possible here. At 70 to, let's call it 67.5, you get about $1. So $1 on a 2.5 wide spread. So about a 66% chance of success there in that underlying security. If you're thinking, this is an interesting point, for support. And the great thing about that is you don't have to say, okay, I think maybe I'll go long, and I'll show you. Maybe I'll go long that underlying vertical spread here, which is going to cost you $1.22. You have the maximum on the upside of being worth $2.50. So basically you pay $1.22, and you could basically double your money, a little bit more, make $1.80. You pay $1.20 to make $1.80. So, here at a relatively midpoint, you can kind of pick the strategy that works for you. But again, the probabilities we trade above 72.5 between now and expiration is 35%. The probability that we expire above, 70 is about 52%. So you always want to measure probability along with the strategy that you're taking in. And the good thing about if your trade assumption is we're right in the middle of a volatility range, you can make that trade assumption based on what you're most comfortable with and what the probabilities are telling you. If we're at 30, well, maybe we err to the side of selling premium. If we're at 20, maybe we err to the side of buying premium, so that we are not only directionally are we matching what our directional or what our intent is of the trade, but we're matching that with how volatility might react to that underlying security as well. So we got about a couple of minutes here, guys. I just wanted to go ahead and wrap up the markets and where we are. We're at 1231 in the S&P 500, up $32. Again, an middle of the range. Again, keep in mind in everything that we're looking at here and all the market action here that you're seeing today, whether or not what your upside price target is for January expiration, you can't deny that we've been in a range from 1200 to 1265. So making a move to 1230, we're right in the middle of this range. So keep that in mind as we go into the January expiration cycle. For those of you, again, following the Dow, we're at 11,989, up 285 points on the day. Crude trading 97.24, up $3.19. Again, making a strong move here. So as it approaches 100, it'll be interesting to see, is there enough market or underlying fundamentals, what are crude inventories telling us about whether or not that's a sustainable number? As the market has told us a couple of times that buyers are seeming a little bit wary of pushes higher than the $100 level. Gold off of a huge hit over or into the December expiration cycle, trading 16.17, up $21 on the day. So with that, everyone, again, we want to thank you for the calls. We'll be here as we always are, same time, same place, next week. As we wrap up here, I want to take one more quick look at gold. And the reason I'd like to do that is, we've talked, we're always looking for these high psychological numbers, and if you're listening, it probably tends to be, I think we do a decent job of mixing up calls with, mixing up puts here. Now, $1,600 in gold. Again, if you look at what support and resistance is telling you from a simple technical analysis perspective, and if you look at this move to the upside that we've made in gold and basically being range-bound, 1265 at an upside level, it will be interesting to see how we hold this 1600 level. I think we'll look for a little bit of confirmation here, but in terms of, if I were looking to making a play or saying, hey, I've got to do something here, I think in terms of probability, just looking at 1600 being a large, kind of support level, I think what will be interesting to do is see if, hey, can we hold this 1600 level for a couple days into January expiration and look for potentially taking on or seeing if selling put spreads here at this level is interesting. And you can do that, obviously, in the futures market, or you can do that in the underlying ETF as well. So feel free to take advantage of either. That said, everyone, that is going to take us to the end of the show. I want to thank everyone who joined us in the Tiger Den on the radio, every one of our callers here today, and we look forward to speaking with you next week. Until then, happy trading, and thanks for joining us on TFNN and the Options Hour. Thanks, everyone.